2021 has been an extreme challenge for insurance underwriters and reinsurance underwriters, for many CEOs, for many actuaries. And this particular thing is really hitting the profitability of cyber business. Cyber business have been for many years one of the most profitable insurance business. This has fundamentally changed. In 2021, the impacts of extortion, single extortion, double extortion, has become tremendous to many insurers. Let's have a look at where we're coming from Distinction.Global. I'm Peter Hackert, the founder of Distinction.Global. For us, Distinction.Global, at the end of the day, cyber risks are fundamentally different than to any other risk. Let's have a look at it. Who are we? Distinction.Global is an independent think tank in the area of cyber risk. We are focusing on really three things. Number one, on validation of models. Number two, on reviewing of models. And number three, in assisting clients to better identify risks, quantify it, and ultimately transfer it in an independent way. This is fundamentally different. We want to see clients who are running their own models, buying in threat intelligence where required, but ultimately have independence towards any stakeholder. And that's the way we support clients, to support them to develop their own models. How is this being done? It's really being done in a 7-step approach. These 7 steps are along the lines of a certain cyber risk management toolbox. We're looking at the incident aggregation chain, which I think is fundamental. We're looking at the way you should look at specific incidents, whether they're deterministic or they're probabilistic. We're looking at loss numbers, we're looking at threat intelligence, and we're developing the model out of this. Ultimately, what you need to do, you need to look at the way this type of risks are compared to so-called natural catastrophe risks. Let's have a look at this and take into account a number of losses. First of all, don't run before you can properly walk, or I sometimes say property walk. As insurers, you have 2 types of cyber risk. You have the types of cyber risk in your existing portfolio, which we call the so-called silent cyber risk, and in the other, the affirmative cyber risk. Our experience after assessing thousands of contracts and thousands of treaties is really the following one. Silent cyber is not that. Despite all the efforts around the world by regulators such as the PRA in the UK and others, there's a lot of silent cyber risk already around the world, starting with property, ending with liability, going to specialty risk. It's a really developing area. Lots of efforts are happening, lots of challenges are still there. Let's take these challenges together on. When we're talking about cyber risk, we're looking at cyber risk in 7 elements. These 7 elements are really built around a toolbox. This toolbox is built around number 1, a knowledge transfer. We are convinced that you cannot assess cyber or cyber incident without having first thought about what does your cover already represent today. These are 3 elements. It's very much on the long side simulations we're using to simulate potential attacks, potential incidents. We're looking at the risk transfer product. And then once we know the policy the insurer is providing, we're looking really the way we assess these wordings. We have 2 fundamental approaches there. One is along the lines of silent cyber. We have a toolbox there, 650 clauses across 35 lines of business. And we also have, obviously, what we call affirmative cyber policy assessments of major insurers or smaller insurers around the world. Ultimately, what we provide to our clients, we provide them either a hedge factor when it comes down to silent cyber, or we provide them what we call an exposure factor. In other words, to which degree are you either hedged against silent cyber or you're exposed to affirmative cyber. Once this is done, there are 2 ways of modeling. One way of modeling is you do it on a portfolio basis or you do it on a single risk basis. We need 3 data points normally. The number 1 data point we need in general is the country. The second one ideally we have would be the individual risk or the location and the size, including the industry we're in. If we look at reinsurance, we have to work with much less data. we have to work with marginal distributions. So very much the approach is then on a notional value basis. Notional value is very much just the shares you're writing, and the modeling technology is there, what we call Bernoulli modeling. Bernoulli modeling is very much along the lines, yes, you are hit or you're not hit, and we're looking at the overall portfolio. If we go into more sophisticated modeling then goes into quantifying modeling, where we use so-called threat intelligence. The use of threat intelligence is very much along the lines of using incident data on the one side, on the other side, an incident catalog. We're looking at vulnerabilities a potential incident has. Let's assume you have an attack against Amazon. Amazon specifically is a cloud provider. There's a single point of vulnerability, single point of failure, which we call in this particular case Amazon. We're looking at the intensity, the revenue dependencies we have specifically to such a cloud, and overall we are modeling the entire portfolio. These are incident probabilities that such an attack is happening over the next 12 months. Now, what we need to do, we really need to quantify the exposure from an insurance point of view or from a reinsurance point of view. How are we doing this? Quite simple. We're looking at the data points we have within the treaty or the direct insurance policy. Is it a silent cyber policy or is it an affirmative cyber policy? We're looking at the type of treaty. We're looking at the potential type of cover. Is it a property cover? Is it a business interruption cover? Or from an affirmative side, is it a network security cover, a data breach cover at the end of the day? These elements need to be assessed, and what you ultimately do, you assign capital to these coverages, which ultimately includes limits, scope, terms and conditions at the end. The way you have to think about cyber attacks is quite simple to a certain degree. Every cyber attack follows a certain sequence. This particular sequence starts, it's either an internal attack or it's an external attack. It's normally a type of malware or a similar mechanism. We're calling this the attacking vector. This particular attacking vector focuses on three things. It's either the IT, the OT, or it's the device. And now what we have to think about is, what are the consequences? We know the attacking surfaces with the perils along the lines of IT, OT, and device. But now what we need to know is, which coverage could it hit? The one cover obviously is silent cyber, and the other one is affirmative cyber. From an insurance limit point of view, or conditions point of view, we're talking about cyber acts, which are malicious, and we're talking about cyber incidents, which are non-malicious. And these, as a combination, is the cyber loss. What is the integrated outcome model which comes out of it? Number one, what you start with is you set incident probabilities. We talked about the incident of cloud failure. This cloud failure related to Amazon has certain incident probability over the next 12 months. But this incident probability only shows you a potential incident for an economic loss. It doesn't give you any kind of insights into an insurance loss. So what we have to take into account here is passive threat intelligence, which is the incident-related aspect, potential active threat intelligence, which are internal apps installed in a company, and most important, I would say, is the vulnerability of the wording you have. Ultimately, we need to find the bridge between an incident probability and a claims probability in the form of an insurance term. This insurance term requires a certain type of modeling. Certain type of modeling is going to be probabilistic in this particular field. We'll see, for instances, we set deterministic the incident in the form of a cloud provider failure. Now, what we do in the next step, we underlying a distribution. That distribution is then probabilistic. Two ways of doing it. One is negative binomial, and the other one would be Poisson distribution. Of course, you have to underlie sensitivities around these distributions. At least this gives you a claims frequency at the end. Once the claims frequency has been undertaken, what we need to do is certain calibration around the incident parameters, which at the end do nothing else show than the adjustment of the parameters before we go into severity. The severity distribution, again, is going to be probabilistic distribution behind a deterministic incident. You stress test the parameters, and most importantly, stress test the correlation between different coverages. The ultimate outcome are what I call exposure curves. They are obviously loss tables, annual loss tables, annual average loss tables, occurrence exceedance probability, aggregated exceedance probability, and most important as well, T-bars. So you want to have a look at the tail risk of a coverage. So this has shown you, in principle, the way we are modeling at the moment, the way things are going forward. The fundamental message I want you to take away here is incident probabilities, in the way you get them from vendors, they show you one insight. It's the probability that you're going to be attacked or you have a hit on the particular scenario incident. What it does not show you is what is really the damage frequency. And in order to get to the damage frequency, you have to take certain aspects into account, and then you can look into the severity. Ultimately, all these parameters we see here, these 4 pillars, or 5 pillars to be exact, have an impact on the way you place your reinsurance. The starting point before you get to any kind of incidents is really you need to understand your wordings. You need to understand the wording in itself, where you're coming from. What are you offering? Because if you don't understand this particular wording itself, how do you want to set the proper incident here? One last look into where are claims today, or where are potential economic losses. In 2018, we did an undertaking for the Singapore government when it came down to potential loss scenarios. We looked at 3 loss scenarios. One was specifically the power outage, the other one was a DNS attack, cloud failure, and the third one was a combination of the 3. What you see here on the right side is really the total economic losses, which were really between 121 billion to 234 billion. We looked at the artificial portfolio overall with different limits. And we showed for Singapore, as an example, the economic loss, which was very much between 450 million to 1.7 billion. And for Switzerland, for instance, 1.38 billion to 2.69 billion. Overall, the entire insurance loss, look into this briefly, was obviously fundamentally different. These numbers were very much driven by different industries. What you see here on this particular slide are the percentages to which degree a country would be hit. In other words, if we have $100, to which degree would Singapore be hit in finance, in retail, and critical infrastructure overall? The end results, which we calculated, was an insurance loss in 2018 on a combined basis between 27 billion and 40 billion. 40 billion is a mid-size hurricane. Out of this 40 billion, roughly 50% plus would have been silent cyber. So in 2021, this number has not massively reduced because there's still significant silent cyber risk involved. The only thing what has shifted from our point of view is the percentage of affirmative versus silent. Whilst we had in the past 60-40 or 50-50 for silent, now we probably have 40% silent, 60% affirmative risk, a lot being driven by particular extortion, particular supply chain risk going forward. BI is the word. Overall, when you model cyber, you have to take 3 things into account. Number 1, it's not just about data. It's about the value of data, the accuracy of data, and most important, how do you get from incident frequencies, or incident probability to be exact, to damage frequencies, and how do you set severities? Lowest hanging fruit is your wording. Understand your wording, and then you're in the position to model. Do it independently. Use data, verify the data, apply it consistently, and take it from there.